put your lender to the test. Tell them, can I do something with no loan contingencies? And if they say no, then you got to ask yourself, did you get me approved yet? Because you got me a letter here that says I'm approved. But if I'm approved, why are there loan contingencies? It doesn't make any sense.
Yeah.
Loan contingencies are a thing of the past.
Hey everybody, it's Josh Alexander from The Brokerage, your host of Orange County Housing Market News, your one-stop shop for all things Orange County real estate. So I'll go over local trends in the market, interview other experts in the field, and then especially if you're a buyer and seller, I'll go over different timely tricks, tips, and advice to help you out in today's market. So if you're thinking of buying or selling a home, please make sure you hit that subscribe, like, as well as the bell button below if you're watching this on YouTube to make sure you're notified every week when I release a new episode. So on today's episode, I'm going to be talking to Dino from California Coastal Loans, and we're really going to be discussing what to expect on the loan side of things in 2022. So we'll go over different changes that have happened in the loan programs and what that means for 2022, what he thinks interest rates are going to do, which I know is a hot button issue right now in 2022, and then also why it's so important to make sure you choose the right lender to be able to give yourself the best chance of getting an offer accepted in today's crazy hot sellers market. So let's go ahead and get into it. Okay, so I want to go ahead and welcome Dino from California Coastal Loans with us today. So Dino, thank you for coming on and joining me. I appreciate it.
Hey, everybody, and thanks, Josh, for having me.
Absolutely. So really quick before we get into the loan side of things, can you just kind of give us a quick intro, who you are, what your company is about, and then we'll kind of go over some questions I have for you.
Yeah, for sure. So been doing loans for 23 years. We are a broker as opposed to a banker, which is a big difference. I personally think brokers are better because, quite honestly, we have access to tons of different banks on a wholesale level. And that always allows for a little bit more creativity and a lot more options. And, I always like to explain, as far as interest rates go and all that, when you work for a bank, you're stuck with whatever interest rates that bank has. As a broker, if one of the banks we work with tries to raise their interest rates too much, well, no big deal. We just move over and we go to this one. And the customer service that they offer us to be able to provide to you guys is bar none the best. They're fighting for our business to help us get our clients the best, not just rates, because sometimes it's not about rates. Sometimes it's about the best program or the best creative way to get into a loan. And that's what we do as brokers. So thanks for having me.
Absolutely. Okay, so I want to go ahead and get into some changes that have happened recently and kind of how that brings us into 2022, and then talk about 2022, kind of what to expect. So buyers that are thinking about purchasing or anybody thinking of selling their home and then buying a new one can kind of at least get a preview of what they might expect coming in 2022. So first, I wanted to talk about conforming loan limits and the increase they have. So for anybody that doesn't know what a conforming loan is, can you first go over what a conforming loan is? And then two, kind of explain what the increase is and how that impacts buyers when they raise those.
Yeah, so this is, in my opinion, hands down, probably the best thing that has happened because over the last 3 to 6 months, I want to say over the last several years, but over the last 3 to 6 months in particular, man, have we seen this huge increase in the price of homes. Yep. So what happens is it starts making it a little more unaffordable for people. And in Orange County, for example, we have 3 different categories. We have conforming, high balance, and jumbo. And conforming is the Fannie Mae guidelines, which makes it a lot easier to get into a home. You can put as little as 3% down, and it's not all that hard to qualify. Once you get to high balance, the interest rate goes up a little bit, but it still keeps the Fannie Mae and Freddie Mac guidelines, which is a positive thing because you can get in now with as little as 5% down. And that's a big deal. Now, not every county has this because it's broken up into counties. Orange County and LA County have all 3 categories because we are known as a county that has super high sales prices, right? So it's hard to maintain a conforming loan balance in counties like Orange or LA. So they have all three. Once you get to jumbo, now that changes the game quite a bit, because on a jumbo loan, you have to have more money down. You have to have a lower debt ratio. It's just a lot harder. The guidelines are a lot harder to get in. So it's broken out. And we have the new conforming loan limits are, I think it's what I got it written down here, 625,000 basically for conforming. The brand new one is 937,500 for high balance, which is huge.
Yep.
Anything above that is jumbo. So now you can officially buy like let's call it a $1 million house, not have to put 20% down, because really all you got to do is put down enough to get to that $937,000 loan amount, and you're in. You're in with easier guidelines, with easier qualifying, and with better interest rates. So it's a really big thing. And then the other piece that what I started with is it's gotten so expensive recently that it keeps pushing people out, right, to Riverside County, to San Bernardino County. And as it pushes people out, the price of homes over there continues to go up.
Yep.
The problem is counties like that historically have had super low conforming loan limits. So it prevents people from actually being able to qualify without having the full 20% down. Now, all of a sudden, you can get a house in Riverside or San Bernardino, and a $600,000, $700,000 house there is pretty darn nice still.
Yep.
So it's a big assistance in getting people in.
Got it. So making it a little bit easier to get into homes, especially with the lower down payment, a lot less red tape you have to cross to be able to get the loan. Just makes it easier for buyers to get into the market, especially if you're a first-time buyer or someone that doesn't want to put a giant amount down, wants to keep more money to put into the stock market or crypto or whatever you want to do now. It's nice to be able to have that option to do a lower down payment on there. Okay.
Yeah. And one of the things I like to say, Josh, also is when you're looking to buy something, right, whether it's a car or a home, like let's say it's a car, if there's a whole bunch of places that offer that car, then typically the price is driven down a little bit, right? If there's only one or two places that offer it, the price goes up. Well, same thing when you're in a jumbo category, you don't have as many banks that do those loans. But when you have the conforming loan limit or high balance, and it's considered a Fannie Mae or Freddie Mac loan, every bank does those, every single one.
Yeah.
So the competition level of keeping rates down is much higher, or it's a higher ability to get a loan. So they're competing, and every time you compete, it's better for the consumer.
Exactly. Yeah. So the higher prices go, typically before, your rates might be a little bit higher, but now you're able to have that higher conforming loan limit, which enables you to have a lower interest rate on those higher priced homes.
Right. Exactly.
Perfect. Okay. So next question, which this is the hot topic of 2022, is interest rates. So right now, interest rates have been hovering near historic lows and have hit historic lows pretty much for the last 18 months straight. They're finally starting to go up a little bit, which in my opinion is good for the housing market, because as everybody probably knows by now, appreciation has been significant throughout the entire U.S., but especially in Orange County and in Southern California too. So it's nice to see those interest rates go up slowly, which is what we want, not a giant spike, but go up slowly to kind of cool the market down a little bit over the long run to get us back to a more normal appreciating market. So we're not having these giant double-digit price growths on appreciation every single year. So speaking of interest rates, two things I want to talk about. So one, as a lender who's in this every single day, that's watching 10-year treasuries and all this kind of stuff to figure out where the interest rates are going, can I get some of your thoughts on what you think that buyers should expect starting out next year, going through maybe mid 2022, or if you want to go all the way till the end, you can kind of go from there. Obviously, none of us have a crystal ball, so we're not going to give any guarantees on these, but just based on the data, what do you see happening with interest rates as we get into next year?
So I do have a crystal ball.
Oh, then you're more valuable than I thought.
It's just never right. So I'll preface it with that, right? Like take it for what it's worth. Nobody knows what the future holds, but I do have a strong opinion on what I think is going to happen, and I think the interest rates are going to start climbing. Although I'm going to personally say that I was wrong. I thought they were going to be a lot higher by today's date than they actually are.
Yeah.
I thought for sure over the last 6 months, rates, would have been higher. And quite honestly, I wish they had been. It would have calmed the market a little bit, right? I mean, all of us who are homeowners love to see the value of our home go up. But quite honestly, I don't want to see it go up that much more. It's getting a little too scary. And that I think always leads to something not so good.
Yeah, the faster it goes up, the higher, the more unpredictable the housing market's going to become. So
more measured growth. So my opinion is rates are going to go up, and I think they're going to. I mean, they already have, but they're going to start going up even more. I don't know how high they're going to get. My guess is going to be probably high 3s, low 4s. And that freaks people out, but please have an open mind and realize that that's still historically very low. And it shouldn't scare you. You shouldn't say to yourself, oh, that's ridiculous, I'm not going to buy a house anymore. That's just stupid, right? It's not high.
Talk to someone who bought a house in the 1980s.
But here's the other piece that I think is going to happen. And this is just me forecasting, but I believe the stock market has gotten out of hand. I believe the stock market's going to see a pretty major correction. In fact, I'm going to go ahead and call it a crash. And I think the number one thing the Feds like to do when stuff like that happens, just lower rates again. Just lower rates. So I feel I'm going to make a prediction and say by the middle of next year, maybe towards the end of next year, we'll see a big stock market correction. So I think by this time next year, you're probably going to see interest rates even lower than they already are. Possibly even the lowest that we've ever seen, even from a year ago when they were ridiculously low. So I think we're going to see that climb, and then I think we're going to see a nice drop. Historically, whenever the stock market does terrible, when there's big corrections, interest rates drop significantly, which boosts real estate. So that's my prediction.
And so in terms of, I know we were talking about this earlier before the show, but in terms of the data, so you showed me a chart kind of going over just the supply and demand of Orange County, because we want to keep it a little bit local if we can. Are you able to bring that chart up that was kind of going over some of that just to discuss that? Because I thought it was pretty interesting to see those numbers that's based on Orange County specifically. Let me go ahead and have you share your screen in a second and pull that up. And I've talked about this on my shows before. So if you've watched my shows before, you know that right now supply is obviously extremely low in Orange County. We have a little over, I think it's 1,800 homes on the market right now, active on the market this time of year. We typically have 6,000 around that amount in the marketplace. So we are extremely low, and it's going to be heading down even farther in the next couple of weeks as we get into Thanksgiving. So the supply and demand is not going to change significantly anytime soon. So anytime I see some data, I love to bring it up. So I want to go ahead and pull this up real fast so Dino can kind of discuss what this is and what he's kind of looking at on his end of things as a lender.
Yeah. So can you see my screen now, Josh?
Yes, I can. Yep.
Okay. So the real estate report card, this comes from a guy named Barry Habib, which I've followed for years when it comes to interest rates. He's one of the most accurate forecasters I've seen, and he helps me in my business, decide if I'm going to lock in an interest rate for a client or if I'm going to wait a little bit, stuff like that. Okay. So he produces this for every county. And a year ago, just FYI, the average home price was $850,000. Now it's $950,000.
Yeah.
But over the last 62 years, the appreciation has been 5.3%. That's not bad over a 62-year period.
Yep.
Right. And then so on and so on. So you can always see buying real estate is a positive thing. People get scared, but the only time you will ever lose money in real estate is if you sell during the downturn. And over the years, I've lived through enough of them. Quite honestly, most of them were just all pretty minor. 2008, granted, it was the last one, but it was also the most severe one. So it scared the heck out of people.
Yep.
But really, if you think about it, we're back. We're back, and we're back way above what they were at. So it's just a function of, if you get into a place can you afford it? Because if you can afford that place, there's no reason for you to have to sell it during a downturn, and you'll be fine over the years. Now, because of supply and demand, he's expecting a 7.6% appreciation over this next year, which obviously we've already seen a way higher appreciation than that, but over the next year, it's still going to be very robust and appreciating. Over the next 5 years, it's practically 40% right here.
Yeah.
So, now comes the question, but is that really realistic with as high as we've already seen? And I'll tell you how he forecasts it. He forecasts it by supply and demand and and birth rates. How many people are coming into market to buy a home? So he says the average age of a first-time home buyer, a family formation, is 33 years old. So if we look at that, 33 years old, to start, let's do this one, right? There's 23 first-time home purchases to be taken from inventory, 23,000, right? Actual homes being built, 10,000. So we just don't have enough homes being built to meet the demand of people that are coming into market. Now, how to forecast out the future? That's today. That's right now. That's been the last several years. But how do you forecast the future? Well, if we know the average age of a first-time family formation is 33 years old, then you have to go back 33 years. And if you go back 33 years, then you need to see what the birth rates are at that time. Well, we've all heard at this point now how many the millennial age group, largest population ever, right?
Yep.
So if we go back and we look, in fact, I think I got a chart right here. Let me pull this up. So let's see if I can get out of this Amazon thing here. So if we go 2021 and we minus out 33 years, that puts us at 1988, which hovers right about here. And if we look, we've been going up this whole time, but 1988, we still have a ton of birth rates. So over the next few years, it climbs significantly. And then, yes, it starts to decrease, but look, it's still higher than everything we've already seen right here, right? If I were to just draw a line right there. So this is what? 1996. So if we take 1996 and we add 33 years to that, that puts us out to 2029. So if we look at 2029, that's still 8 years away of high birth rates, high appreciation, people coming into market. That's why we have so many people moving out of state right now, not just for political reasons, but also affordability reasons. And we're seeing this kind of appreciation everywhere because we have so many people and we have such a big, huge lack of inventory. And quite honestly, with the pandemic that just hit, people, the builders just can't build fast enough either. So that's
and they've been underbuilding for probably 15 years now, pretty much ever since the last crash. I mean, they've been underbuilding in the US and in our area, pretty much everywhere. And that's really been one of the main drivers of this big supply issue is they're finally starting now to get the building back up to a point where over the next 4 to 8 years, we can maybe start catching up. But again, like you're saying, if they continue going at a very quick rate, let me go here, unshare that real fast. If they continue to build at the rate they are right now, it's still going to take years and years and years for them to catch up to the demand. Because as I've stated on my show before, millennials, the largest demographic patch in the United States right now, are reaching those prime home buying years, and there's a lot of them. So that demand is not going away. Interest rates will have an impact on that. So if all of a sudden next week we saw interest rates at 5%, 6%, that would definitely dampen that demand and have people put on pause that home buying. But over the long run, when the interest rates came back down, you'd still have that demand there. So the underlying demand is very strong in the housing market right now. And like you were saying, with the interest rate side of things, I mean, the government is always going to try to make sure if we have some kind of financial crisis that they're going to drop the interest rates and allow people to purchase more homes. And if people are worried about inflation too, owning real estate is one of the best bets you can have against and hedging against that inflation too. So next year, a lot of people are worried about, is inflation still going to continue to go up? Is it transitory? Is it not transitory? A lot of people are worried about that. Having that real estate in your profile, whether you're owning property as your primary residence or even as an investment property, is a really good bet against that inflation happening.
Yeah, 100%. And something else, Josh, and you can probably speak a little better to it, but in the old days, you had to make a decision of, is it worth spending that much money to buy, or should I just keep renting? Because quite honestly, renting is a little bit cheaper. You don't have to fix anything when it breaks. There's all these like positive things, but rents have gone up so much that now you can't justify saying renting's cheaper than buying. So my advice is always beg, borrow, and steal. Do whatever you have to do to come in with enough money to get your house.
Yeah.
Even if you have to live with roommates, even if you have to, suck it up and go ask mom and dad for a loan, whatever it might be, it's a great opportunity to do it because we can forecast out over the next several years that it's going to be good. And quite honestly, if you're in that millennial age group, right, which you're not even a baby anymore, all of a sudden it's like, you're getting married, you got a job, you got a baby. And I've read all the books on millennials, they didn't want to get married. They wanted to live in high rises. They wanted to be able to be walking distance. They wanted to do all this stuff that the book said. But the one thing that they never, ever actually thought about, and that's Mother Nature. And when a woman gets pregnant, I tell you what, the majority of all those wants and needs change. All of a sudden, they want a safe place to live in. All of a sudden, they want a garage because the baby's asleep and they want to be able to pull in and out. I mean, there's so many things that happen and change. And all of those things now are coming to fruition.
Yeah. And I'm a stereotypical millennial example of that too, because I was living in a condo when I first got married. And then as soon as we found out we were having a kid, one of the first things we're doing is looking for a house. And so I think it was 45 days after my first kid was born, we moved into a house from the condo. So, I mean, that's where people want. They want to be able to lay down and basically put their roots someplace and get that real estate if they can, to be able to use that for years. And you were saying something earlier too, which is extremely important for buyers to know, is that unless you're trying to speculate and trying to time the market with housing, you're saying, I'm going to buy it now, I'm going to sell it in 2 years and try to make a profit of it. Most people are trying to purchase a property that's going to fit their lifestyle for the next 5 to 10 years. If you're doing that, you can afford the payments. The payments aren't going to be changing, which is nice thing about rent, is if you're renting, those payments can go up every single year at a much faster pace. So you really can't financially plan into the future in terms of what those payments are going to be. When you have that house, you're able to kind of get a financial base under you, understand what your payments are going to be. And as long as you can afford those payments, whether the market goes up, whether the market goes down in the short term, you're going to be able to weather that because you're just looking at your monthly payment and that's it.
Yeah, and let me add a little something to it. One thing I see a lot is there's people that try and make all these financial decisions on their own. They'll do a little research on Google or do whatever but they don't really know the answer. One of the things I love about your deal over here, Josh, is that you're actually giving a lot of value. You're educating, and it's a real great thing for people to be listening to. But do yourself a favor. And not you, Josh, but the listeners, right? Do yourself a favor and actually consult with somebody that really knows what they're doing, because you don't know everything. And there's so many changes that are happening all the time. And Google, as great as it is, has a lot of stupid stuff on there too. And it scares people all the time. Let Josh or myself help you with a financial plan. If you don't quite qualify just yet, let us help you put a financial plan together to get you there. It's a lot easier than you think. If your credit sucks, don't worry about it. We will figure something out. But there has to come a time too where you have to start making your payments on time. You have to be able to start, earning more money. There's a lot of things that have to happen. But why don't you consult with a professional to get to that end game, to get to that goal a little bit faster? We can help you with that.
Exactly. Yeah. Make sure that you're actually doing some research. It's important to do research, and you can look at Google and stuff, but that only gets you so far, especially when you get to the local market. Because a lot of the things that you're reading is nationwide, and that doesn't apply everywhere. You're reading a lot of stuff right now where inventory is increasing. That's not happening in Orange County right now. Inventory
Yeah.
is not increasing. So you need to make sure that you have that local expert to be able to use with the other research you're doing. So that's a great point, Dino. So last thing on interest rates before we move on to the last question. So in terms of interest rates, I have a lot of buyers because they do believe interest rates are going up. They want to know how the rate locks work. So they maybe have heard about it before, maybe they haven't heard about it before, but they want to understand when they get a loan, when they actually can solidify the rate they're going to have for their mortgage, and so they know what their payments are going to be. Can you go over a little bit about how that works in the lending side of things when you get your rate locked in, and how that kind of plays out, and what kind of options you might have with that rate lock?
Yeah, for sure. So I'll tell you the traditional way. There's some options, but here's the traditional way, the way it works the majority of the time. I've actually had people ask, great, I'm pre-approved. Can I lock in my rate? And most of the time I say no. And the reason why is, well, you don't even have a house yet. You got to have a house. You got to have an address. You got to have something tangible to see if you even qualify, right? Now, there are certain program or certain banks out there that offer like 90-day advanced locks, but you're going to pay a lot higher of a fee to get that rate. The interest rate's going to be higher. I'm more about just roll the dice. Unless we know something big is happening and rates are going up like 1%, just roll the dice. Go out and find yourself a home. The second you find a home and get an offer accepted and we have a contract in place, that is the best time to consider locking. There's going to be, once we have that ability, let's say we have a 30-day escrow, well, now we have to play a little game. Where's the market going? Is it looking like it's heading up? If it is, let's lock it now for 30 days and we're covered during our escrow period. If all of a sudden things are changing and we're having good days in the market and things have been getting better and there's some news out there somewhere that's causing interest rates to get better, I always just say, let's ride the wave. Let's see if we can get a little bit of a gain. Sometimes we can gain a quarter point. And one of the pieces of advice I'll give you is that when you go into buying a home, you got to be ready for a up or a down of a quarter point. That's about the margin that rates can change on you within a short period of time, depending on what the market's doing. So when we pre-qualify people, pre-approve them, we always pre-approve them at a quarter point higher. And I tell them, look, when you find your house, if rates are the same or better, you're going to be very happy. But I'd like to prepare you for something worse because I feel the rates are going up, not down, right? And that way you don't get into a house expecting to have a payment of $3,000 and then all of a sudden it's $3,100, right? I'd rather you be prepared for something worse and then be happy when it's better. That's the right way to do something.
Okay. And so, that's important for buyers to know too, because just thinking about that in terms of how that applies to escrow, a lot of buyers right now are having to do longer escrows because the seller wants to be able to find homes of their own, and they're doing like a 60-day escrow or something like that. So you need to understand how the loan side of things works in terms of how you lock your rate in, when you lock your rate in, when you are agreeing to do these longer escrows, because that can impact the amount of rate the rate you can get, as well as if you want to lock it in for a longer period of time, expect it to be a higher cost to you in terms of that percentage that you're going to get overall. So it's good to keep in mind when you're placing offers, when you're doing those extended escrows that are over 30 days, because there's just going to be inherently more risk in terms of interest rates fluctuating more when you're giving a longer time frame.
Yeah, and if you're okay talking about this, Josh, I mean, my personal belief and advice when I talk to clients is it's not always the highest rate or the highest sales price that wins the offer. It's the best deal, right? The best package that you can put together. And I'll tell you, I have clients sometimes, they just want to offer $20,000, $30,000, $40,000 more because they don't want to lose. I'll tell you what, though, you nailed it when you said sometimes sellers want a longer escrow because they still have to find a replacement house. Well, I'll tell you what, I got a bunch of kids, and if I told my wife we have to move now and then temporarily somewhere living out of boxes and suitcases. And then when we finally find a house, we have to move again. She'd tell me I'm crazy. She would tell me to take a lower offer than the higher one just because she wouldn't have to move twice. So the best offer sometimes isn't the highest priced, right? So my advice is always close as early as you can. Like we always offer 15-day close of escrows because now you stand out in the crowd. Most people can't do that.
Yeah.
And then offer the seller a chance to live there for up to 60 days, right? Or a certain number. And that gives them the flexibility of, number one, having the money in their account, because they can't get an offer accepted either until they actually have the money, right?
Exactly.
So that helps solve problem number one. Problem number two, they have a little bit of time and they don't feel like they have to get out of the house right away. And that, especially if there's kids involved, is game over. It's
life changing.
As you probably know, Josh, just offer them they can stay there for free. I mean, heck, how much is your payment? Let's call it $3,000 a month, and you let them live there for free for 2 months. That's $6,000. Other people are offering $20,000 to win, right? If you offer 2 free months, that's better.
And that's all about, and I've talked about this before too, is that you need to understand what the seller's motivations are before you place those offers. So it's important that if you're talking to your agent, you're placing offers, that agent needs to be calling those selling agents to be so they can understand what the seller is looking for. Because if they want that longer time frame to be able to find a property, you want to be able to kind of talk to the selling agent and figure that out ahead of time, figure out what exactly the seller is looking for, and that's going to give you the best possible chance of getting your offer accepted. And that's definitely happened to me, and I'm sure that's happened to plenty of your other clients that you work with, where they don't have the highest offer necessarily, but they're more flexible to what the seller needs, and therefore they're able to get their offer accepted, just like you're talking about. So that's a great point to bring up.
100%. And then 2 other things I'll bring up. I got to tell you, working with an agent just because you're related to them, or working with an agent just because you want to be nice because you're friends, isn't always the best move. Do some research, find out how many deals your agent is closing. Make sure that they're capable of representing you properly. And then ask yourself a simple question. If you were going to go out and buy a $50,000 or $60,000 car, would you trust that agent to go negotiate the best deal for you and you be hands off? You'll just take whatever they say? Because if you can't even trust them to do that, why would you trust them to go buy a $500,000, $600,000, $900,000 house?
Yeah. Are you saying there's agents out there that don't know what they're doing? I don't believe it. I don't believe it.
Work with an agent that knows what they're doing, and one that is on your side, and one that isn't as eager to close the escrow as you, because they get, their paycheck sometimes clouts their judgment. You got to find one that's more interested in treating their client, you, appropriately, right? And that's one thing. The other thing too, that the lender is so ultra important to this deal in today's environment. I believe, and maybe I'm a little biased here, but I believe a good listing agent will go through all the offers. Obviously, they'll probably sort them by price and some of the other things that we talked about, but they're also going to sort them by who the lender is. And if you're dealing with a big online lender, that's been around for a while, everybody knows them, you see them, their commercials all the time. But if you're dealing with one of them, the majority of listing agents are a little bit gun shy of accepting those offers because they don't have a good reputation of being able to communicate properly. So if the listing agent calls and can't get a call back, they don't like that. Number one. Number two, they have a bad reputation for never closing on time, and that screws everything up, right? And then number three, a lot of times they just screw up and then they can't close. And now you're deep into escrow. Your buyers are all messed up and the deal can't close. You have to put it back on the market, and that just changes everything, right? So big online lenders are probably the worst place to go. The second worst place to go are the big banks. Even though I trust them more, they don't have a good reputation because you don't have anybody that actually has ownership of the loan. So like when you're my client, right? When you work at one of the big banks, you get passed around to everybody and there's no ownership. So you got to work with a good lender, and one hopefully that's a local lender that is well known in the community, and they can offer certain things. For example, put your lender to the test. Tell them, can I do something with no loan contingencies? And if they say no, then you got to ask yourself, did you get me approved yet? Because you got me a letter here that says I'm approved. But if I'm approved, why are there loan contingencies? It doesn't make any sense.
Yeah.
Loan contingencies are a thing of the past. It used to be, hey, honey, it's Saturday. Let's go walk into some open houses. Oh my gosh, I love this house. Let's buy it. You go, you stand in front of the realtor that was holding the open house, you write an offer, and then you get 21 days to get your loan put together because that's your loan contingency period. Well, that doesn't happen anymore. Can't even see a house unless you have an approval.
Yep.
So have a real approval, not a pre-qualification, right? And if you have a real approval, there's no reason to have any loan contingencies. Otherwise, you really don't. So question them on that. Number two, something I offer all the time, but ask your lender, can you offer a penalty per diem? Which means if we don't close on time, can you personally pay the seller? I offer $250 a day. If we don't close on time for any reason whatsoever, even if it's not my fault, I don't really care, right? I'm going to offer a $250 a day penalty per diem paid by me to the seller if we don't close on time. That speaks volumes to the seller. So again, it's not the highest offer, it's the best offer, right?
Yeah.
And if they know, if you're saying you can close in 15 days and you're putting your money where your mouth is and you're offering a penalty, I got to tell you, like if I was the seller, that's the one I would have the most confidence in. And that's what you got to achieve when you put your package together. Have a good agent that understands this, that can be aggressive. Find out what all the important aspects of the sellers are, right? Do they have kids? Their whole situation, how fast they want to move, all that stuff. And then work with a good lender, put a good package together, no loan contingencies, short escrow periods, and penalties if you don't close on time. That will make you stand out in the crowd. And that, in an environment where everybody else is complaining they can't get an offer accepted, I guarantee you'll get an offer accepted.
Well, you must have read my mind because that had a lot to do with my last question on there. But that definitely, so a couple things. One, absolutely everything you said, and that's helped me. I mean, you work with a lot of my clients too to help them get into homes, and that's helped me get them into homes even if they didn't have the highest offer. So there's proof in what Dino is saying here because I've experienced this myself. And then I've also experienced myself working with those lenders that are the national lenders, the ones that really a lot of times you're just a number to them. And if something goes wrong in the transaction, this is the step you can take. And if this doesn't work, then I can't help you. Whereas if you go with someone that has a little bit more responsibility and kind of like Dina was saying, is actually responsive to clients and is solution-based to try to figure out how they can make it work. When problems come up, you have someone on your side to give you 10 different options on exactly how you can solve this problem to still close on the house. And that's why it's extremely important, especially in today's market, especially in the market we've had the last 18 months and going forward, because it is going to be a seller's market going into 2022, to have not only a good agent, but you have to have a good team. You have to have a good inspector. You have to have a good lender, and the lender is there to help you get your offer accepted. A lot of buyers don't understand how important lenders are in getting offers accepted. So Dino kind of talked about the per diem. So anybody doesn't know, that's per day, basically. So if they don't close on time, every day they're paying $250 to the seller because they said they'd close and they didn't do it. So that's something that's just showing the seller that, yes, this lender means business. They know that you can actually purchase the house and they're willing to put money on it. Another thing in terms of what Dino does and what anybody working with the lender should be doing is making sure that the lender is calling the selling agent to basically go over the financial side of the offer with them. Because yes, as a agent, I can talk to the selling agent and say, hey, they're good to go. Their finances look great. But it means a lot more when the lender calls the agent and says, hey, this is exactly what's going on. There's no problem whatsoever. We've already gone through all of the underwriting process. They're approved. We don't need loan contingencies. All we need to do is get into escrow. It makes a huge difference to give that selling agent confidence when they're presenting offers to the seller, to tell them, hey, maybe this is not the highest offer, but I can pretty much guarantee this one's going to close. So you brought up some good points on there. So anything else? I can't think of anything else right now, but is there anything else that you can think of in terms of what buyers need to know for 2022 going in on the lending side of things that you'd want to kind of end with?
Not really. You know, there's a lot of changes, but we got to kind of wait and see how they play out before I can really give advice on it. I would just say, you know, get yourself with a good team, make sure you're interactive with them, and get a good financial, you know, plan together on how to get there. If you're already ready, great. You know, get approved, be done, and wait for that perfect house to come. Don't jump at a house just because, right? Like, make sure it's the house you want to be in.
Yep.
When the right house appears, trust me, with what we just talked about, you'll have an excellent chance at getting your offer accepted. And then all the extra stuff that's happening, we'll just kind of wait and see, right? As the new year happens. I know there's a lot of talk about, you know, the SB9 we talked about, ADU units and all this other stuff. Well, they're not really playing out as much as everybody thinks just yet. And it depends. Like, if you live in the city, it maybe has a little bit more value to it, right? But when you live like in Orange County, especially in the suburbs of Orange County, right? Like South Orange County, for example, or in, you know, PUDs like Aliso Viejo and places like that, where they're all tract homes, it's a little bit harder to do stuff like that.
Yep.
So as all these new laws come out that California has released, as they come out and we see how they actually affect our local area, then I think, Josh, you'll probably want to do something on that. And
I will. Yep. Yeah. And if anybody has any questions about SB9, they have no idea what that is, check out the link. I'll put a link up in the corner of the video I did, kind of explaining the whole process of it. But there is, like I stated in that video, a lot of unknowns, a lot of gray areas, because it hasn't even taken effect yet. It doesn't go into effect till next year. And when it does, it's going to be a process for cities, for counties to kind of work through it, figure out how this is going to be implemented, and really to get a better idea of what's going to happen long term. We won't know that for a few years because it's going to take a while for this kind of stuff to roll out. So anybody that's scared about having duplexes built all around you and turning into a giant city where you're not going to be able to get in and out of your street because of traffic, just know that's not going to be an issue. But I will definitely keep everybody updated on what's going on with that as more updates come out and we get some more clarity on what's going on with SB9 and SB10 as well. Perfect. Okay, well, appreciate you coming on today, Dino. I think there's a lot of great information on here for both buyers and sellers. You seem to always be a wealth of information, so I appreciate you coming on. I think this is your second or third time on here, so thanks for taking the time with me. I appreciate it, and I'm sure I'll probably talk to you again at some point soon.
All right, brother. Thank you again.
So again, I wanted to thank Dino for coming onto the show today. I know we discussed a bunch of different topics, so hopefully you were able to find some of that useful and you're able to take that information and use that and apply it, especially if you're thinking about buying or selling a home in 2022. So until next time, stay healthy, stay happy, and I'll see you on the next show. Bye.